I know they want it to go back like it was the last 10 years, but I think that was an anomaly, and I'm not certain we ever get there again.
On today's episode of the What the Finance podcast, I'm happy to be hosting Ted Oakley, who's managing partner and founder of Oxbow Advisors. So, Ted, it's wonderful to see you. Thanks for joining.
Thank you, Anthony.
No problem. So, my first question: what is your current perspective about the markets and what we can expect for 2023? Because, but I'm sure if we looked at 2022, not many people predicted what was going to happen then. So,
Well, I think what happened last year, if you look back on it, it was caused by interest rates, Anthony. But if you look at this year, I think it will be caused, at least for the foreseeable future, by the economy. And by that, I mean, by keeping these rates up and everything, you're obviously going to have lower earnings, lower profit margins. And we felt like all along, all the numbers on the street were too high. So we're looking for, we're still looking for some weakness in the marketplace sometime in the next few quarters.
yeah, it's interesting because I guess a lot of people have probably thought that the economy has gone past that. It's sort of it's maintained its strength during this period and it's going to potentially be a soft landing. So you do think that's going to happen?
It's surprised people. I think, like today, the producer pricing came out. It was much higher than they thought, obviously affecting the marketplaces. The same way with building permits, they were lower than they thought. I mean, you can see this weakness in the economy coming in, and everybody wants to talk about a soft landing, but when you look at the yield curve and what it's done historically, that's not telling you that it will be such a soft landing. It'll take a while, but I think we do eventually get there.
Yeah, it's interesting. As you said, people are almost just like waiting for that positive news and then jumping on it and then sort of ignoring all the bad news that's coming through as well.
That's true. Yeah, a lot of speculative activity is back. I mean, that's really all we've had in the first 6 weeks has been speculative activity that was really buying the companies that got beat up so badly last year. So, in a lot of meme stocks, a lot of the crazy stuff.
Yeah, definitely. So I guess last time we got sort of the yields inverting before 2019, we had a bit of a drawdown and we've had a drawdown recently. So I guess from your opinion, you're just saying because the economy hasn't had that reaction, that's why we could potentially see further downside.
Well, I think so. I mean, we're using, we came into this year and the street was like $233 for the earnings for the S&P 500. We felt all along that would be more like 200 maybe. Well, 4,100, even at a 4,100 S&P at 200, it's certainly not cheap. It's not even cheap at they're down now to like 221, but we just think it's over. They're not realizing what's sort of coming. And the markets are not cheap there. 20 or 21 times is not a cheap stock market.
Yeah, definitely. And last year we saw stocks go down, but at the same time we also saw bonds go down, which hasn't happened for a while. Do you think that bonds will go down as well, or what's your perspective on that?
Depends on where you are on the curve. I mean, if you're say 5 year, if you have 4 or 5 year maturities, they've been going against you because of the Fed is raising the rates here on the 1 year, and that sort of thing, but it affects the 2 and 3 and 4 year too. While as a long bond, if you go 2030, they're obviously going the other way, and that's why you have this inverted curve. So I think probably most of the damage is done in the bond market, unless inflation really stays up. If it does, it's going to be another tough year. I don't see that, but we'll see what happens.
So you think that we'll probably see disinflation over the coming year?
Well, when I say disinflation, Anthony, I'm thinking instead of we just came in at like 6.2 or whatever, and that was higher than people thought. It's still fairly high, a long way from 2, and so you could drift back to 4 or something like that. I don't think you'll do it soon, but over the course of the next few quarters. But that's certainly not at the 2-point level, and probably longer than people expect to get there. So that's what we're thinking on that.
Yeah, and I guess it provides less urgency for the Fed to cut rates. And then, as you said, it brings your scenario more into the forefront where the economy is going to struggle as there's higher rates for longer.
Anthony, there's too much obsession with that. Everybody's obsessed with trying to figure out what the Federal Reserve is doing, and they've told you what they're going to do. And there's certainly, everybody keeps talking about a pivot. I'm like, well, you can't pivot until you stop going up. You got to level off first, which hasn't happened. So I'm always surprised that everybody, I know they want it to go back like it was the last 10 years, but I think that was an anomaly, and I'm not certain we ever get there again.
That's interesting. Yeah, they wanted what is it? Thinking about cutting. That's what everyone's trying to
Yeah,
predict.
something like that. Yeah.
Yeah. So if you don't think we'll see what happened in the last 10 years, what do you think we'll see, I guess, this decade?
The next 5 to 10 years to us, it looked as though if you looked at the total return, that it was going to be in the range of, unless you knew how to trade. Now, if you can trade and make some money, that's different. Okay. And we do a little bit of that. We will put money to work, take it off. But yeah, if you just sit there with it, I think it's going to be lower than last decade, and certainly probably somewhere in the 4 to 6% range. But heck, that may turn out to be pretty good. I mean, we went from 2000 through 2012, we were 1%. So I don't know how it ends up, but I've got a feeling that it won't be as great as it was the last 10 or 12.
Yeah, it would be hard to follow up that. So you mentioned that too many people, I guess, pay attention to what the Fed's going to do. So what should they be paying attention to, in your opinion?
Well, for us, we value the individual entities. Now that we look at single companies, we look at single bonds. We don't buy the exchange traded funds or the indexes. And so we're always looking to try to buy companies we think are undervalued. And so we look at that. I mean, if we found them today, we would still buy them. Now, right now, we don't have many because we run some pretty big screens on companies, and they just don't hit the number for us. But that's what we look at. I think people need to try to get away from where the Fed is, because they don't know what, the Fed's never been a good indicator of what you should be doing. And I think people need to get back to look at what you own. Look at things. How much cash flow does it pay me? And how is it set up? Is it a great value? There's so many companies out there today, Anthony, that don't have any revenue or earnings. They're basically just worthless companies, but they trade on the exchange. So we stay away from things like that. But you have to look at what do you want to own, and how do you want to compare it to, say, a private business or some other real estate or something else. That's how you have to look at it.
Yeah, a lot of those companies done well at raising money for the founders, but not much for
That's
other
true.
people. Yeah, so I guess so from your perspective, we're probably going to see a shift. I guess the 2010s, it was the classic growth company, especially the end of 2010s. So do you think we're going to see a shift more back to value and value overperforming?
Well, you probably could. Usually when a market makes a low, okay, and I don't think we made a low, but when it makes a low and people really capitulate, that kind of thing, then growth is really cheap. It's as cheap as value. So you can buy either one at that point in time. And I don't think you could, I know it's outperforming the early part of the year, but that's because people were waiting to really to trounce on tech because it got beat up so badly. And so you've had that normal bounce, a big bounce, and that looks different than it should be. But I think they'll both be okay. We own different companies for different things. We own some companies because they grow really fast and they don't have a lot of debt. And we own other companies because they've just got really great balance sheets. They're going to be steady earners. They've been steady dividend payers. You have to look at what you own. I think people need to do that more.
Yeah, it's really good. It's like anything. Look on your side of the fence rather than on the other side, and
Yeah.
what you're missing out on.
Well, if you turn on, that's a good thing about your types of programs. You're actually getting down to the meat of investing. But if you turn on a lot of networks and that sort of thing, all you get now are people that are sort of don't manage money, but they're still pontificating about where the market's going, this, that, and the other. I always like to talk to people that manage money, Anthony, because they have to put it on the line every day, like we do, and that makes a difference. I like their opinions better because they're having to put it. They're out there playing on the field right now, and that's different than somebody that just puts out strategies. It's totally different. So that's who I pay attention to, and then as investors, they should do the same.
Yeah, it's a great point. We won't say any names, but yeah, there's quite a few of them out there that have a reputation for not being right a lot of the time. And I guess you don't have to be right all the time, but it's just that risk management and then making sure that, as you said, you know what you own.
Well, the difference is if I'm just if I'm just a strategist or I just put information out and I think the macro is doing this or that or the other, I can go on down the road 6 months or a year, and if I'm wrong, who cares? I didn't hurt anybody. Whereas if I'm managing money, I get a report card every day, every week, every month. Okay, a report card, and sometimes it's not exactly the report card you want to see, but it makes you realize, you're out there, and I don't care how well you did any year. And we had a pretty good year last year, but you can't live on that because people start you all. It's like playing a football season. They start you all over on January 1, and that's why people that manage money, no matter what category they're in, I have a lot of respect for them because they're on the firing line every day.
Yeah, definitely. So you mentioned before that you're analyzing opportunities, but you're not really seeing many out there. Is that, I guess, reasons you mentioned at the start? There's challenges in the economy. I guess is that to do with their balance sheets, that there's lots of debt, and maybe obviously the cost of refinancing is going up. What are, reduced earnings? Are those the main things you're looking at?
You know, what we look at when we screen for companies, we're looking for double-digit growth. We're looking for companies that has their debt is in line. Debt will kill you in any private or public company for that matter. So we're really sensitive to debt, and we're sensitive to free cash flow after making capital expenditures. You can have a company that's selling really cheaply, but they're spending all their money, on having to pay down debt and that sort of thing, never really expanding the business. It doesn't mean anything to you. But if you've got a company that's continually producing free cash flow, they have to do something with it. They can either pay you more in a dividend, and a lot of those, a lot of companies we own don't have that much debt right now, so they just stack the money up, and in some cases, go find other companies. Those are things we like. We like that more than them buying back their stock. I'll put it that way.
Yeah, definitely. It makes sense. So, on a recent interview, you were talking about how you think there's going to be a lot of challenges in the markets, which you've mentioned now, but also that there's could be a lot of public companies that actually go bankrupt. So, I'm not sure if you want to explain why you think that is the case and what will cause that.
If you go back and look at like the Russell 3000, which are most stocks, okay, you'll find that there are maybe the highest percentage, and I don't have this number right in front of me. We have it though, of companies that aren't making any money. I'm talking about they either zero or they lose money. And when you've got that many companies that we've zombified sort of in the last 10 years, and they had all this free money, so they could just keep on going borrowing because they didn't spend any money on it. It was a quarter of a point, maybe 1%. So you could keep these companies alive. It's like keeping them an IV forever. But now they can't do that because the rates are too high. And so all of those companies are going to get into cash flow squeezes for them. And the worst thing you can do in a company, and I've owned companies outside of this company too, is when you get in a cash flow squeeze, you do some drastic things. You cut a lot of people. Some people go bankrupt. I mean, there's a lot of things come out of that, but it's basically because they don't have any cash.
Yeah, that's always the issue running out of the runway. So, I was talking to someone recently. His name's Michael Howe, and he sort of looks at liquidity in markets, and he's mentioned this as well. He was talking about the challenges that a lot of these companies may have with refinancing their debt, especially at the rates they are. So he was mentioning that every year, I think it's about 70 trillion, sorry, dollars of US dollars of debt needs to be refinanced, which is just crazy to me. And I think when you compare it to the Fed's balance sheet, which is 8 trillion, it's not something they can actually come in and solve. And I guess that's what a lot of people are hoping for, that the Fed will come in, the knight in shining armor and save everything. But if it got that large, and they wouldn't be able to do that.
Well, I'm sure that's a great interview you did with. I don't know Mike personally, but I know a lot about what he does and the liquidity area. He's up to speed on liquidity, and I couldn't give anybody he's blamed for thinking that way because I think he's right on the money. But that's the problem. I think people don't realize. Last year was the first year, the fourth quarter last year, the first time we'd had M2 money supply shrink in 60 years. So what's happening is you're taking money out of the system, and in the banking system itself, and mezzanine financing and everything. Those rates are starting to go way up, and so it's getting to a point to where companies can't afford to take down the debt because they don't get a big enough return to get it. And certainly the companies that don't have any revenue or earnings, they're out of the market at this point.
Yeah, they're just trying to fight for their survival at the moment. So let's say this were the case that a lot of these companies were to, go bankrupt or go out of business, then, you mentioned there that you're looking at cash flow, free cash flow that the companies are producing that you own. Is there any other assets that you'd be looking at to potentially preserve your wealth or even to grow it during that period?
Well, I think you can start to look at municipal bonds for people that have, when people have a lot of money, I'm talking about 50 million to a billion. They can't do, they're not going to be all in the market. I mean, they have a lot of safe money and that kind of thing. And we do a lot of that type of work. But now the municipal rates, the tax-free rates have really moved higher. So you can even do, 2, 3, 4, 5 year tax-frees and get a good return. You can get a really good return on the 6 month treasury. U.S. Treasury today is like 5% or 5.01, which is great. And you don't pay state tax here in the States on if you're in the state that has state tax. And so you're starting to see that sort of work. And I think people could start to look at that. The second thing is you have to realize that if I want to just wait and see how this thing sort of pans out over the next couple of quarters, right now the federal government will pay me 5%, 4.9 even on a 1 year, just to wait, just take a look. I don't have to do any, I'm not in any rush to do anything. And so let's say, so far this year, you see the S&P up, but if you try to go forward, you can say, well, if I'm getting 5 no risk right now, what do I have to get in the stock market to make it worth my time this year? Okay, for us, that's 10. In other words, that needs to be double. And we don't have to see the kind of companies that are giving from this level. And I'm not saying it won't give it to us, but I think it'll be at a lower level where we deploy cash.
So what level do you think, I guess, the overall markets could get to?
I was telling you about companies we look at, and none of those companies hit where we want to own them right this minute. A few do, but gold miners and different things like that. But generally, if you just take the overall earnings of the S&P, let's say we're right, okay, and we do the 200 instead of 221 like it is now, or some of them are 216, 217 now. Which is coming down. Let's say we do that. Well, the market's still at 20 times. So you got to hit something along the line of 3,000, 3,200 or 33. You got to get that number in line because, and it could be worse than that. But in order to be a 16 multiple, you're going to have to be at 3,200. That's all I'm saying. And that's still not dirt cheap by any stretch, but a 15 is an average multiple for a long time. So maybe 3,000, 3,200, unless you get into a really tough situation where we go back like we did other times and go to a lower double digit, like a 12 or a 13, 14. It's different. But one thing being around a long time, Anthony, you know this for sure, that you don't know anything. You don't know what's going to happen, and you have to really manage money with the idea, okay, that, I want to try to be set up for all outcomes. If it's really good, I want to have enough money in that area where it works. And if it's really bad, I want to know that I've got such a safety valve. I'm okay there too. But I think people go all or nothing, and that's a tough way to trade.
Yeah, definitely. Because I'm sure a lot of them wouldn't be too happy with 10%, but that's a great return in these markets.
In this market, if you, by the way, Anthony, and we're up for the year, but if somebody said, I'll tell you what, I'll take your percentage you're up for the year, and let's say I'll guarantee you 10 to finish the year at 10, I'll take it.
Might be another Bernie Madoff or something.
Well, I, I've been around all along. I've seen so many more other than Madoff too. You've been around as long as I have. You've seen all the scams, and so it'll always be there. I hate to say this, but there's always going to be scams.
Yeah, definitely. And then if we go to, I guess, precious metals and commodities, do you think they will sort of benefit from this drop? Or I guess if there's economic slowdown, then I guess industrial commodities could go down, but then potentially precious metals might go up.
I think, Anthony, what will happen on commodities is that they will weaken. They're weakening now. If you look at the CRB index, I think that's indicative of a slow economy. If the economy's slowing, then you're going to see oil. Look at natural gas at 260. I mean, all of that's slowing, okay? And if that is correct, and this usually does happen, the commodities front run it, as they're going down, they will be a good buy somewhere, because we think this decade will be a series of up and down in inflation, not just, some steady number that they pull out of the air. So there'll be a spot for commodity. It's just not right here. I know we sold our oil producers, or big oil, like, Chevron, Exxon, Devon, those kinds of things. We sold them sometime back, actually. We sold them last year in the fourth quarter, and people wondered about that. But we said, look, we're getting ready to go into a recession here. Those companies are going to, I know you think oil is tight, and it is, but it doesn't have to be when things get weak. Well, sure enough, that's happening now. Now, we still own the royalty companies, the oil and gas royalties. So if we miss it and the price does go on up, then we make a lot more money on the royalty. So no, that's one of those things where you're going to make it either way.
Yeah, so it's as you said before, being positioned that no matter what, you're going to still get a reward on what happens in the market.
That's what you try to do. I mean, we always look at, what I always try to look, we've tried to look at our biases, because I always try to ask ourselves, and I ask all the portfolio managers here, what are we missing here? What's something that could happen that we're not expecting and nobody else, but it could easily happen, or that sort of thing. We're always trying to find out what could sneak up on you, so to speak. And that's the better way to say it,
Yeah, and I guess from your opinion, I guess what do you think people are missing out on?
Well, I think two things. I think one, there's too much talk about a soft landing. That's pervasive now. And so either one or two things going to happen. No landing at all. In other words, we don't have a recession, or it's pretty tough. And you got to try to watch that, because that'll be something. If we were to have a hard landing right now, that would catch most people by surprise. And then all of a sudden, see, we've gone from everybody being really negative on the market in November, December, to all of a sudden we exploded the other way. So everybody now is really positive. They're in the market, various things. But, I've seen it before. I mean, I've seen numerous years where the first month or first 6 weeks were really popped. 01 did that. 1977 did that. I mean, there's times when you get a move like that. 76 did that, but you'll get a move for 6 weeks or so, and everybody thinks, oh, here we go. And then you roll over, and the rest of the year is not all that great. I don't know if it'll work out that way. I don't know anything like that. But one thing I know for sure, I have no idea what's going to happen. We just try to manage through it.
Yeah, it's a great way to look at it. So I guess if we sort of ask a similar question, is there any industry that you think is maybe underappreciated at the moment, or you don't think it's getting enough attention?
Well, I think the gold miners are. You could buy them gold miners today, as cheap as you could buy them really in the last 3 or 4 months, in our opinion. And if you look at them, look at Newmont Mining, a 5% dividend. I mean, that's a better dividend than a utility. And so, in price to cash flows on these companies, and you look at, we own Franco-Nevada, which is another way to play the gold price, because it's a royalty company. You don't have to have all the CapEx in there, but we own Pan American Silver. There's most of these pay a pretty decent dividend. I mean, we own Agnico Eagle, which is not as high as Newmont on the dividend, but it's better than the S&P. Those are some areas. Now, when we say own them, we own maybe 5 to 6% max, and all if you combined everything. So we're not. This is not a bet the farm deal. I'm just saying it's just one of the positions we think is cheap.
Yeah, it's really interesting. So, Ted, thanks so much for your time today. I really appreciate it.
You
Um,
bet, Anthony.
yeah, no problem. And I guess my last question is, what is one message you want people to take away from our conversation?
You know, if there's one thing you want to be doing out there is I think you need to be what I would call agile. You need to be able to be in a position with your investments right now to where you can't get backed into a corner with what you own at this particular time. And because if you own just one category of bonds or stock, whatever, and you really bet everything on that one category, and then you get backed into a corner, right now you need liquidity, cash or treasuries to be able to be agile. But I'm agile, I mean, if something comes out of the blue and you have some really cheap prices, need some money or you can't take advantage of it. So that'd be my advice to people.
Yeah, making sure you have that liquidity available, if no matter what happens. So, Ted, thanks again. I really appreciate our conversation. So, if anyone wanted to find more about your work, I know you've done a few of these interviews. Where would the best places for that be?
You know, the best place, Anthony, is just to go to oxbowadvisors.com. Everything's there. We have books. Be glad to send you, or, you know, all of the interviews we do, most of the market letters we put out. Um, Everything's there. We'll have a new market letter out the first part of April, and we'll do another video then. But all of it's on the website. You can see it there.
Yeah, perfect. I'll put that all in the description below. So, thanks again.
Okay, thanks, Anthony. Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.